Good deal. So, as John said, Richard Denenny. I'm the president of Lee & Hayes. We're a primarily an intellectual property firm with offices. I'm based out of the Pacific Northwest, so I came in today as part of a visit to the office, and one of my colleagues there, Andrew Eisenberg, said, well, if you're in Austin, why don't you come by and help out with the Small Business Festival and give a quick presentation. I joined Lee & Hayes about a year ago. Prior to that, I ran a software company, 150-person software company that was built out a natural language processing platform that they use to develop intelligent virtual assistants, primarily for web self-service. So think Siri for business. And prior to that, I was at the huge law firm of K&L Gates. So 8 years at K&L Gates, took the opportunity to make an honest living, as John said, jumped into the entrepreneurial role, did that for a number of years, great experience, and then joined Lee & Hayes about a year ago doing that one. I also couldn't completely leave the entrepreneurial space, so I sort of followed your model, and also have a truck manufacturing business to kind of keep my finger on that one, and that's a very non-sexy industry, but we're trying to do some exciting things as a platform play with it. They're happy to talk about it. So we're here to talk about term sheets, and before we go there, Yeah, absolutely. Well, let's talk about it. How many here have raised capital in the past? Okay, a couple folks on there doing it. I've had the experience of both being on the attorney side and on the entrepreneurial side of raising capital at the software company next to T. We raised about $8 million of capital doing it in both sides. And we're going to talk through some of the basic mechanics of a term sheet without going into too much detail, and really just primarily do what we're saying there is just give you a sort of a high level understanding of what a term sheet is. So let's just talk about it in general. What is a term sheet? It really is just a basic understanding between the parties. It really acts as a roadmap for the transaction to sort of see if you're in the room of negotiation or realm of negotiation, if you will, on that one. It usually occurs after, if you go through the sequence on this thing, you'll sort of do an elevator pitch, sort of make a quick introduction with some potential investors. Go through that, usually do a little bit more formal investor presentation where you're going through that one, and oftentimes I'll actually combine this presentation with a walkthrough, sort of what I consider to be the framework that I've used in the past for putting together investor presentations. After that investor presentation, oftentimes if there's interest on both sides of it, then you'll sit down and start negotiating a term sheet. And oftentimes you'll sort of signal, as on the entrepreneur side, the company side, you'll signal sort of what you're looking for in general in the investor presentation. But then after that, you'll sit down and really start talking through a term sheet, which provides that roadmap. Term sheets can go across the spectrum on it. I mean, you can have a very basic term sheet that says I'm going to invest X amount of dollars at usually, amount of dollars and what the valuation is and your percentage interest, and that can be it. It can be 3 paragraphs. Or it can be incredibly detailed. They can span on for 8 to 10 pages if you really want it to and get into the details. One of the first questions that I always am asked is, details versus really high level, just understanding on these things. And from my perspective, and my practice tends to be more on the company side. I do represent a couple of investor groups that tend to be early stage investors, but for the most part, I tend to play the role of outside general counsel for early stage companies and doing that. So I tend to have a little bit of a company bias. I'm just going to reveal that. And with that hat on, in general, the more details you can get ironed out at the term sheet phase, the better. And I'm saying that from the company's perspective, but it's also true for investors. From the company perspective, I think that's the case because you never have more leverage than you do at the term sheet phase. That's when you've got the interest. You've got a number of people who are swimming around the lure, taking a look at you and going through it all. And so it's your opportunity to really to negotiate. Once you've got the term sheet in place, and it kind of goes to this next one, you got the term sheet in place. It's generally non-binding. Every time it's non-binding for the most part. Just take that as a rule of thumb, except for a couple of key provisions, most notably confidentiality and exclusivity, oftentimes on that as well. But invariably what happens is once you've got the term sheet going and you're really far along, you pretty much pick your partner and you're going through it all. And at that stage, once the term sheet's there, you've sort of lost your leverage in a lot of respects, and you can always walk away, and I've certainly done that in the past in my experience on the company side and the attorney side. but I've never regretted getting into details on a term sheet and really walking through it. We're not going to go through all those details today, but doing that one. Going back, the last thing on this one is just self-explanatory, but you'll see a lot of fancy words thrown out around term sheets, especially around a typical venture capital term sheet, and going through that one, and people will sort of get thrown off by what the heck's a broad base, weighted average anti-dilution provision, what's a full ratchet, what's a liquidation preference, all these different terms, all that kind of stuff, and they're all important stuff, but at the end of the day, they really are distilled down into business economic terms, and it's really where the most important negotiations occur. The most important points you're going to agree to are at the term sheet, and oftentimes before you get an attorney involved, and I'm not here to say that's wrong by any means. I think you just need to make sure you have the right business advisors and that you understand what levers you're pulling in a term sheet. Other things that a term sheet really helps do for you is it helps you, like I said, it usually occurs after the investor presentation. And it oftentimes takes the form of diligence, even before you start really going through and getting deep into a lot of the diligence. It's a way for you to get to know the investors if you're on the company side, and the investors to get to know you. For some of the investors that I represent, actually, they take the term sheet and the related negotiations as a way of really testing the leadership team. In particular, if it's a leadership team that doesn't necessarily have the same track record that they'd normally look for, or that profile, we'll use the negotiations to really test them. So oftentimes that'll take the form of picking a deal point and saying, Richard, I want you to really be aggressive on this point, really try to take it, not necessarily because you're trying to actually win the term, but it's oftentimes to understand how the leadership team is going to react. Are they going to get really upset and walk away from the table? Are they going to immediately escalate? Are they going to come back to you offline, talk business person to business person? How do they manage it on? It's a really good way of getting some really important insights into who you're dealing with on it. But before we even get there, though, I think it's a really important point, and you were asking what a term sheet is, and related to that is why even do a term sheet, or why even raise money in the first place? It's a foundational question that you have to ask yourself, and as part of asking that, really sitting there and looking at what type of investor are you looking for. And so for those that have raised capital in the past, obviously familiar with the different spectrum on it, but oftentimes your initial funding is coming from yourself, friends and family. Then oftentimes it'll be an angel round where they're really friendly early stage investors and going through that one, and then moving up the food chain to more institutional capital, and then going from there. Oftentimes it'll take the form of strategic partners where you're looking for not only access to capital, but access to particular markets, people, networks, and otherwise on that. And so really asking yourself what type of investor are you looking for, because they're not all created equal. I mean, the 10 million from one firm versus 10 million from another can look dramatically different based on who they are and what they can bring to the table, in addition to the money they bring to the table. Other question to ask is do you need interim financing? Do you need money right away? Or can you wait? Where are you at in your development plans and going through that one? We're not going to go into it here, but there's some funding mechanisms that you can employ to help to raise interim capital. Most primarily, that takes the form of a bridge note. That is a promissory note that will convert into the next equity round. So it's a way of doing it. So understanding how quickly you need the money, if you need something right away on it. Often underlooked, how much do you need? Expect investors are going to always ask, use of proceeds is a fairly, that's a foundational question they're going to ask, and it goes both ways. Depending on the type of investor that you're dealing with, oftentimes they're going to have a funding nut that they're going to need to hit. They need to deploy a certain amount of capital in order to make it worth their time. They've got an administrative burden whenever they put capital into a company, and so they, a large fund on that one's not necessarily going to be interested in a $150,000, $250,000 investment unless it's a seat at the window with the anticipation of a significant raise later on that one. But related to that is how much do you really need, and what are you going to use it for? And then last question on this one is, do you have the right corporate structure in place? Are you ready to even raise money? Have you incorporated? Do you have the right instruments in place to actually be able to take money? And all these are are really easy to walk through and solve, but I think it all leads to the question asking yourself, are you sure you want to take investor money on? And for me, I was always really loath to take on money. And at the end of the day, I never really felt comfortable until we were able to manage our cash flow to a point where I understood where the spigots were and I could turn them off, and so that I didn't have to raise capital. Because otherwise you're handing your company over and you're really waiting on that one. So I was always and still believe on this side to this day that raising capital oftentimes, especially really early, is not the right answer. And really asking yourself that question and going through it. So on the flip side, there's a number of companies you don't have a choice. It's the way you scale and everything else on that one. But it's important to ask, do you even want the money on it? So we're going to then talk about some just critical deal points. As I mentioned, a term sheet can take the form of 8 to 10 pages on this thing, and there's a whole laundry list of issues you want to go through and everything else. I want to focus primarily on liquidation preferences, which we'll go into that in a second, but it's the most material deal term that you're going to see that can skew the economics of the deal and going through that one. And so I want to sort of focus on that, and then we'll touch on some other ones, time permitting on it. So when I say I want to focus on liquidation preferences as a primary deal term, people are often surprised and they always want to talk valuation. Valuation is really sort of the headline number. We all see it out there. And everyone will say, so what's your, you're raising, 5 on 20, whatever what's your valuation? You're going to get asked that one. And so you'll hear this thing, pre-money valuation and post-money valuation. Pre-money valuation is the amount of money that the company is valued at prior to taking on any capital for that raise and going through it. It's almost always determined on a fully diluted basis. So, for this group in here, how many of you are run a company currently? Doing that? Okay, so not many. So when you form your company and you're looking at going down the startup route, you're going to have a conversation with your core team around what's the relative ownership of the founder group, your initial employees, and related to that is how you're going to attract and retain employees going forward. Most prominently, that takes the form of an equity incentive plan and granting options to your employees coming in. For this one, so what fully diluted means is it's going to take all the shares that are issued and outstanding, plus all of the instruments that are out there, so options, warrants, convertible notes, that can be converted into stock. And they're going to assume that all of those instruments are going to be converted into options. So for a stock option plan, when you're looking at it, you're saying, okay, what do we need to do for our employee base going forward? You'll hear sort of the industry standards on this, up to 20% and everything else on that one. As you're walking through a term sheet and understanding valuation, you just have to realize that the option pool that you set aside, so let's say you want to have 20%, so which means, let's assume you're got 1 million shares, you're going to have an option pool of let's 200,000 or whatever you want to do on that one. Those additional 200,000 shares will be counted in for the pre-money valuation. So under that scenario, if you've got a $2.4 million valuation with 1 million issued and outstanding plus 200,000 available under an option pool, you're going to be valued at $2 a share on a pre-basis on that one. Kind of put in the back of your head, it's called the option pool shuffle. Sometimes you're going through that one. Fully diluted, when you have those options, if you don't ever issue those options, then it creates an economic boon for the investors coming in on that one. So for an example on that one, on a $10 million valuation, pre-money valuation, if you come in with a 20% option pool, you only use 10% of the option pool, and then you have a liquidity event, cash it out. It's the effective equivalent to $1 million adjustment in your valuation and going through that one. So lesson there is fully diluted. Fully diluted basis is the way you determine your pre-money valuation. Post-money valuation is the pre-money valuation plus the amount invested. So you hear things like a 5 on 10, which means a $5 million investment on a $10 million pre-money valuation for a $15 million post-money valuation. That relates to your underlying share ownership percentage. So, a 5 on 10, so a $5 million investment on a $10 million pre-money valuation is going to be a $5 million investment on a $15 million post-money valuation. That investor or investor group owns 1/3 of the company at that point in time. Make sense before we go on? Questions there otherwise? Okay. And I think, on that point, share your stories, and we can all learn from each other or just ask questions. Otherwise, I mean, this is a small group, and so we can be, really informal going through it. I'm happy to share war stories of mine on for whatever they're worth.
Valuation is often overrated.
Yep.
I have a friend who's in mechanical engineering, and they're 3 PhDs, and they had this new technology for printer material.
Mm-hmm.
And he said, yeah, we got this investors $1.5 billion, and then it evaluates our company to this, but we're still living, in Cheetos. I mean,
Yeah.
it means nothing. I don't know. I'm going a different approach. We talk about it.
Yeah.
So we're going a bootstrap in my group.
Yeah.
But valuation.
Yeah, it's obviously important, but I do think it's often overrated, and you particularly see that in the case of the unicorns that we'll talk about a little bit in a second. But to your point, there is a distinction too. I mean, raising capital and bringing money in at whatever valuation doesn't necessarily mean, and usually doesn't mean, because investors are usually loath to give money into a company, especially early stage, just to allow the founders to take money out and create a partial liquidity event for them. Oftentimes, if it's a round that's past the really early stage, you'll see salaries starting to take into effect and people aren't doing it. But you're right. I mean, it's for the founder group and the employee base. Just because you raise capital at whatever valuation will create a paper gain for them, but it doesn't necessarily put food on the table and going through that one. So I think when I say valuation is overrated, it really ties to the fact that valuation is just one of many key economic terms in a term sheet that you're going to end up negotiating on this thing. And sophisticated investors will gladly, if you take it just at carte blanche, and I was curious if you agree with me or not, will gladly let you pick the valuation if they get to pick every other term. And I think you see a real world example on that with unicorns. So do you guys know what unicorns are? Sort of the billion-dollar valuations that you see out there. I think last statistics were up to about almost 250 unicorns out there. As you sort of dig into the deal terms and sort of understand what's going on there, is oftentimes there's this chase to be a unicorn. And so you'll say, and the investors are willing to sit there and say, okay, yeah, we'll value at $1 billion. We might only value at 500 million or 750 million or whatever the case may be, but we'll go ahead and value you at $1 billion. But we're going to create other economic terms in the term sheet that are going to guarantee us our effective rate of return on this one. So it takes the form of aggressive liquidation preferences, special IPO provisions on it, real strong control rights to be able to go that way, even so far as you can have, guaranteed, required dividend payments on these things or whatever the case may be, to guarantee the term. So going back on this one, I should back up, give this one. So I'm talking, when you're raising capital, I'm assuming we're talking a corporation, and we're making a distinction here, and we're talking through issuances of preferred stock. So a company can have common stock or it can have preferred stock. Preferred stock just means that it's a form of stock with rights, privileges, and preferences that are superior and different than the common stock on it. And it doesn't always have to be superior on it, but that's the way it is on that one. So we're talking preferred stock. So this is a separate class of stock with unique rights associated with it on this one. And so if the investors are able to pick all of the other rights, they will oftentimes give you whatever valuation you want on it, assuming they want to deploy the capital. Of those different things that the levers to pull, especially earlier stage, liquidation preferences are the most important and the ones that can swing the economic terms most drastically. So let's talk about liquidation preferences. It's the right of the holders of preferred stock to get their money back, and often more, before the common stock upon a liquidation event. So last money in, first money out. That's the rule. Just is. Agree? Yep. Last money in, first money out. And a liquidation preference is the amount of money they're going to get out first on this one. Yep.
This is also, just to add something, liquidation preference is also where you want to pay the most attention to, because it can be one of the biggest gotchas in there. Because I may have given you, or other VC companies, or other angels, or other funding areas may have given you something very, very small, but my liquidation preference is at 10x, 20x.
Yeah.
So I may have given you $50,000, but I get $1 million.
Yeah.
And if you sell for $1.1 million, I get $1 million, you get $100,000.
Yep.
So that's one of the gotchas.
It is, and we'll walk through a use case. So we'll throw the numbers up there and we'll actually walk through it and doing it with just one hypothetical on this one. But that's exactly right. And it goes back to the point that valuation doesn't mean a whole lot if you've got the right liquidation preferences. You can get there with your liquidation preference. Two primary types, participating and non-participating. At a really high level, participating means that I get my liquidation preference back, or my liquidation preference. So, you know, in today's market, things have gotten a lot more reasonable, and I consider to be, especially for early stage companies, 1x non-participating preferred with the right to convert to sort of be what I consider to be the most common liquidation preference these days, which is a lot better than it used to be. I've seen up to 4x and doing it, and I've heard stories of even much more aggressive than that. So what that means is that if it's a participating preferred and with a 1x liquidation preference, that means I invest $5 million. I'm going to get $5 million back before anyone else gets 1 penny. And then after that $5 million is off the table, I'm going to share pro rata with the common stockholders on a as converted basis. So if you own 1/3 of the company and you sell for $15 million with a 1x participating preferred, you're going to get your $5 million, and then you're going to share in 1/3 of the remaining $10 million. And again, we'll walk through an example on this one. Non-participating means that you've got your liquidation preference. So you're going to say the investors are going to agree with you on how much money they're going to get first. Last money in, first money out. They're going to get their money. And then they don't get to participate in any value above their liquidation preference unless they convert. So that means that they have to convert to common stock. So under that same hypothetical, where you've got an investor with a $5 million investment in a company that sells for $15 million, and they've got a 1x non-participating preferred, they're at a $15 million. It's kind of interesting. They're just going to get their $5 million. They get their money back. They could convert and own 1/3 of the company, but they're not going to get any more. They do that. You sell at $20 million. They're going to convert. They're no longer going to rely on their liquidation preference because they would get more in converting because they own 1/3 of the company. Simple math on this thing. Company sells for $20 million. They're going to convert in order to get 1/3 of that $20 million instead of just their liquidation preference. So participating, liquidation preference plus pro rata. Non-participating means that you're capped at your liquidation preference unless you convert. Now you can get into the different levers on this thing. You can have non-convertible preferred shares on that one, which I've seen, and actually some of the huge liquidation or valuations out there, you see that. Oftentimes though, it'll be with a multiple liquidation preference. So yes, I can't convert, but it's a 5x liquidation preference, 4x liquidation preference. Early stage, I don't really ever see preferred shares that don't convert. I don't know if any other folks do. Yes, sir.
Question: what happens if you raise on the seed round?
Yep.
Then on round A or whatever, another investor wants to have preferred. So how will they?
Yeah, it's a really good question, and it's one of the things as you're thinking about your need for capital and how you want to go about raising capital. It is incredibly important not to create a legacy capitalization problem, and it's one of the reasons why I think investor terms have become much more reasonable. Is to your point, back to my same last money in, first money out. So if you're an investor coming in and you're driving really, really onerous provisions at an early stage, unless you're really willing to write the check every single time, at some point another investor is going to come in on top of you, and at that point in time, you're going to have to realistically waive a lot of those rights, have a severe down road. It can be really traumatic for the business, but you're going to have to deal with that new investor coming in. You know, what really happens on this one, if the company's in desperate need, needs the money, and there's no opportunity for liquidity events or otherwise on that one, which can be where it's dangerous. So as an investor, you know, going through a hypothetical on this one, I drive really onerous terms on this one, and I've got a 3x liquidation preference on my $5 million. Company can be sold tomorrow for $10 million, or it can take on another $5 million, but I have to wait, you know, I have to convert into a different form of stock with a much less onerous preferences and everything else on that one. I'm going to do the math, and I may really try to force the company, not waive my rights, and force the company to sell at that 10 million. I'm going to get it back, and not have the new money come in. Does that make sense? So you've got rights as a preferred shareholder. Put your investor hat on. You've got rights. You can't be forced to waive them. Well, it depends on how it's negotiated, but generally speaking, they're your rights. And the new investors coming in, if they're not willing to invest because you've got too onerous of rights, then it becomes you as the investor a choice. Are you going to waive those provisions, modify them, or how are you going to address it? Or are you just going to force the company to effectively, you know, cease existing? Does that answer that question?
So only one investor can have liquidity preferences?
No, and you'll hear the term of waterfall analysis, and you're going through that one. No, I have one client that's done A1 or A1, A2, B1, B2, all the way to E2. and I mean, so no, you can keep stacking it and working through it. You know, at that point in time, generally speaking, in that situation, you've had a really strong core investor that's carried through the entire investment round and has really led it and has allowed that to really happen. But it hasn't been a complete mirroring of investors through each class. But you can have multiple. Yes, sir.
How long do these investors expect to participate until to get money? I mean, they must expect the company to eventually make money.
Yeah.
And if they keep, I mean, how many rounds
Yeah.
to go?
Yeah.
My friend's already talking about the second round.
Sure.
For this company.
Sure. Yeah, and it's so I mean, going back to who your investors are, and if you're raising institutional capital, you know, one of the questions you want to ask, where are you at in your fund life? I mean, you need to get your money to your LPs at some point. And, you know, they're in the business, and the only way they can do that is through a liquidity event. And so when do they need to do it? You know, from my experience, a 10-year fund life is I don't know what yours is.
7 to 10.
7 to 10, and doing that one. From my experience, investors are typically looking at a 3 to 7 year for their money back. I don't know if that's consistent with.
That's about right.
And-
And going on a little bit more on seed versus Series A, oftentimes, and correct me if I'm wrong, oftentimes seed, at least in here, or in Austin, will be angels or something like that, that'll do a convertible note.
Yep.
So upon Series A, which is considered a liquidity event, they would convert. So they may not have, they may convert, or they may have something different, but a lot of people will say, okay, I got you by with $300,000 for 6 months, 18 months. Now that Series A is here, I want to be out of here, or I convert and stay with you the rest of the way. But a lot of them will convert.
Yeah. Nope.
And Series A typically will be where the preferred stock comes in.
Yep. Yeah. Sometimes you'll see the term Series Seed as a term out there and doing it, but no, absolutely right, absolutely. I saw another hand out there.
So is that the advantage of why an investor would want to do a bridge note?
Yeah. Convertible.
The advantage of a convertible note is that it doesn't establish valuation for your company.
Exactly.
And so A, it doesn't establish valuation, and B, you don't have to give anything away.
Yep.
So if your company just basically exists on the back of a napkin right now,
Right.
you avoid setting a valuation, because if you set a valuation now,
Yep.
you could have set it too low or too high.
Right.
But once you set it, then that could be attractive or not attractive to a potential investor.
Yep.
So, and the second thing is you don't have to give up any of your company.
Yep.
At least not right now.
The
Yeah.
thing that most entrepreneurs would love to do, is really hard to do, is you just pay back the convertible note, and then you don't have to give them any equity. But most of the time, you can't do that.
Yeah. Yeah, that's especially at that earliest stage is remarkable. But you're exactly right. I mean, a convertible note is primarily designed to push off valuation. That there's uncertainty, usually because there's you're dealing with the earlier stage investors, and they want to piggyback on the valuation that's going to be established when the institutional money comes in. You can't really agree to it. It's too early. You've got an inflection point coming to the company that you're waiting to see on it. So it's a way of bridging the uncertainty on valuation. It is also a really cost-effective way. I mean, a convertible note offering you can do really, really cheap. Even, you can do $1,000, $1,500, $2,000 for an attorney to put that stuff together for you.
But there's still something you can be negotiating, right?
There is. It's usually the conversion discount on that one. So it's. It used to be you would negotiate warrant coverage, but you've got tax implications that it becomes a discount. So you've got tax issues on warrant coverage now. So really, the main negotiations are around the discount upon conversion. I consider 20% to be sort of the industry standard these days on this one. Some discussion around the interest rate that's going to accrue and convert. So you're doing that one. So 8% is about what I'm seeing most these days on this one. You'll also see, and you touched on it too, is if there's a mandatory conversion and at what level. And so what's the valuation need to be to force, or the amount that you're going to raise that's going to force a conversion? And is there any repayment obligation? Is it a true note instrument, or is it really disguised equity? And that's it. And it's something, and I'm happy to talk about convertible notes after this, but its short version is it's a great tool to have in your toolbox for interim financing to bridge a valuation that you can do really quick and simply and push off valuation discussions as well as preferences and privileges and everything else. And there's 4 or 5 key economic terms that you have to deal with, but primarily it's the conversion discount. Okay.
I was actually just going to ask.
Yeah.
How often do people sell common shares versus preferred shares?
Yeah, it depends on how who your investor base is. I have one company that's raised $25 million common. I mean, it's really unique. There's no institutional money. It's all high net worth individuals that are mostly friends and family. That is really, really rare. And the reason why it's rare on that is, one, the investors that are putting that much capital in want some protection and everything else. But even at a more foundational level, and that's why I really, even on the company side of this, preferred shares, I get it. Because let's, hypothetical scenario, you start a company. You do it on a $5 million or $3 million pre-money valuation. You sell 2 million shares, $2 million worth of shares, so now you've got a $5 million post-money valuation. The investors own 2 million. You do it common stock. You as a founder, the next day, can sell the company for $3 million. They're going to get 1.2. You're going to get 1.8. And doing that one. So it's the so. My opinion, sophisticated or really early stage friends and family, common, that's sure. Once you start getting any type of sophisticated money, they're going to want preferred shares for at a minimum to avoid that dynamic I just described. Does that make sense?
Yeah.
Okay. So 2 hypotheticals to really drive this home. So option 1, a 5 on 10. So a $5 million investment on a $10 million pre-money valuation, a $15 million post at a 1x non-participating preferred. So that means I'm going to own 1/3 of the company, and I don't get to participate in any proceeds above my liquidation preference of $5 million unless I convert. Option 2, hey, a much higher valuation, $5 million on a $15 million pre-money valuation. So I'm selling 25% of my company at a $20 million post-money valuation. But oh well, it's a 2x participating preferred, doesn't really matter, which may end up being true in doing that one. So let's walk through the mechanics on this one. This is just a real rough, down and dirty waterfall that if you have, to your point, if you have multiple preferred shares, you've got, could be a really complicated waterfall analysis. On this one, it's going to be easy on this one. So you start looking at this thing, and it's really interesting. It's not until you get to about the $80 million mark that the 5 on 10 results in more money to the investors. You know, even at $80 million, it's a little bit less on that one. So what happens on this one is that you can kind of, you just really see this. So this 5 on 10, 1x non-participating. So what that means is they're going to convert at any liquidation preference above 50, or any liquidation event above $15 million. So they own 1/3 of the company. They own more of the company than you do over on this one, but the economic returns associated with a liquidity event don't come out in favor of the person who owns more of the company until that $80 million mark under this scenario. Contrast that with option 2, the 5 on 15. I mean, it's really quite remarkable on this. So an exit at $20 million, so that's the post-money valuation, the preferred's actually going to get $12.5 million. You thought you just sold 25% of the company, but the reality is you sold 60% of the economic return at a $20 million valuation. Just dramatic swing of that one. And then what happens though is, and this is where you can get, you know, it can make sense, is you get down to the bottom here, you know, at this one at a 10x return at a $200 million valuation, the preferred do make less. And the reason for that is your liquidation preference as a percentage of your overall economic return decreases as the overall size of the liquidity event increases. So at a $200 million valuation, even though it's 2x participating preferred, because your 2x is $10 million, the fact that you only own 25% of the company versus 33% of the company at a huge valuation, the investors don't do as well. But it's quite remarkable when you do it. Now this is picking two different ends of, not full ends of the spectrum, but going through that one. Questions, comments, thoughts on that? That's kind of a rough way to try to illustrate the economics of liquidation preferences. Okay.
I'm sure the contract would be very, very detailed. There would be a lot of terms. I mean, you're going to have people who make the contract, the investors who are making they have their attorneys, and then you have.
They do. You know, it's interesting though. You know, I would be loath to spend too much on attorneys. You know, and I'm an attorney. I run a law firm, and the reality is the terms of venture financings have become so well understood. The forms of documentation that are out there are really pretty good. I mean, you can go to just the NVCA and use their forms as an industry standard on that and be able to do it. You have to understand what levers you're pulling, so what goes in and what doesn't go in, but the actual negotiation of a preferred round, if done with lawyers that know what they're doing, shouldn't be that expensive and or that contentious. Once the terms are agreed upon, the way that should look in the form of a contract and mostly in your articles of incorporation is where your preferences reside and going through it. And everyone's got horror stories with lawyers and going through that one, and they can be really difficult in going through it, but they really don't need to be. You know, for us, the quotes that we'll give out there is we can do a preferred financing for 10 grand and do the whole thing, and I feel really comfortable with that. And it even can be less depending on you know, how involved you're going to be at the term sheet phase. So, but the documents are lengthy, but the negotiations don't have to be contentious. So we've got about 3 minutes left here, and so I'm just going to quickly highlight, this is going to be way too much on this one, but I just wanted to highlight some other terms. So as we said at the beginning, preferred stock as distinguished from common stock. You've got rights, privileges, and preferences that are different than common stock. And liquidation preference, in my mind, is the most material of those terms that you need to be aware of because it can dramatically skew the economic impact of the investment, what it means for the founders, the employees, everything else on that one, and for the investors. But there are some other ones in this one. Anti-dilution. What that means is the investors coming in want to restrict or have it be punitive at various levels for you to take on capital at a valuation that is lower than what they sold to you at. And that one, it can take two forms, well, multiple variations of this: weighted average and full ratchet. Full ratchet is really increasingly so rare. What that means is if you sell shares at a price that's lower than what you sold to that investor, and they have a full ratchet anti-dilution protection, their conversion, their shares are going to be effectively revalued at whatever that new price point is. And the reason why it's really rare is it dramatically, it doesn't take into account the full economic impact of that subsequent investment. So if you sell one share at 50% less than what you sold to the previous investors, and the previous investors had $10 million worth, their entire round's going to be adjusted upon conversion for that 50% discount. So most prominently, it's weighted average, which takes into account the total economic impact of that down round. So it takes the number of shares and the value, and it's a fairly robust formula. So just know for you guys that as you're going through a financing and you're thinking about it, that the investors, rightfully so, are going to want some protection against dilution. Dividends, it's really a non-issue. They'll be in every term sheet and every finance will do it. It's usually, when, as, and if declared by the board, non-cumulative dividends. As early stage companies and high growth and everything else, investors for the most part are not looking to make an equity investment in order to get dividends. This is not a dividend play. They're looking for capital equity appreciation on this and dividends, but it can be out there. I actually had, and this is on redemption too. This is a war story. We ended up not taking the deal, but we were at the company and getting really close, and we couldn't really bridge the valuation gap effectively. And this was one where they needed they really were worried about getting a liquidity event, and so what they were proposing was actually to have cumulative dividends that didn't have to get paid, but they would accrue, and then a forced redemption right that does that. So a redemption means it's a put right, that the investors have the right to force the company to buy your shares back. It's really a bet the company provision, because if you don't have the money to pay it back, you're selling, and it's a real deal. Now, this is where the right counsel involved and trying to make distinctions between their exercise of a redemption right via through their representative on the board of directors versus a shareholder, and if you can wrap around fiduciary duties. There's some good war stories I've got around that, but it can be really really dangerous for a company. Voting rights and board seats, count on when you take on institutional money, you're going to have someone on the board, or at least as an observer. There's been a gradual move towards observers. Reason for that is board members owe a fiduciary duty to all shareholders, not just the ones that put you on the board, all shareholders. And so your decisions have to be exercised through the prism of that fiduciary duty. If you're an observer, which means that you've got access to the boardroom and you're in those meetings, you've got all the information, but you don't vote as a board member, you don't have those duties. And then you would exercise your rights through a shareholder rights provision that says you can't, as a company, do certain things without the shareholders' approval, the Series A approval or Series B, or whoever holds those shares in doing it. At its best, it'll take the form of you can't sell the company without our consent, and it can be as dramatic as you can't deviate more than 10% off your operating budget. I mean, it can go across the no salary adjustment. It can go across the spectrum as far as how much control the shareholders want to exercise. And that's protected provisions. Right of first refusal, coal sale and drag along rights, restrictions on transfers, and if you do transfer the shares, their ability to either sell along with you, or before you can sell, you have to offer it to them or to the company. And going through that one is a classic package for a preferred round. We'll have a investors' rights agreement, voting agreement, right of first refusal, coal sale agreement on that one. And then my favorite, I just throw it in there because it's my favorite lever to pull when I'm dealing with a really aggressive investor. Is at the end of the day, it's called pay to play. And if you find yourself having to take money and have really aggressive terms, say, okay, we'll agree to that. But when we go to the market for the next round, and we bring in investors that are willing to invest at whatever terms, you either have to invest or you convert. So pay to play. So it's put your money where your mouth is in order to try to avoid that legacy capitalization problem that we talked about previously on it. So really quick, rocket docket on additional terms on it. Sort of final thoughts as we're starting to run over here. Create competition. Multiple term sheets are your friend. It's a market. Try to have a few out there. Try to go through it. Like I said at the very beginning, in my opinion, is your most leverage is at the beginning. And so use it. Choose your investors wisely. It's a long-term partnership. I mean, it really is, especially if you're coming in early on these things. Vet your investors. It's not, diligence doesn't go one way. Do reference checks. How active are they? How aggressive are they in wanting to create a liquidity event? How willing are they to come down the road? How flexible and understanding are they when you miss your projections? What's their track record of replacing CEOs? Do they have, you know who your investors are, and are there promises to make the introductions to X, Y, and Z? Do they really follow through on that? Do they open up their Rolodex? Ask those questions and get references. And like I said earlier too, not all money's created equal. If the right investor comes in that can give you the right access and otherwise can be unbelievably valuable to your company above and beyond what the investment amount is. And then last and not least on this one is understand your capital needs. And it's back to this idea of a legacy capitalization problem on it. Especially at the early stages, whatever those investment terms are, tends to set the DNA for future capital rounds and going through that one. And so understand that, and then also understand the principle that the last money in is the first money out. And they're gonna, the sophisticated investors are gonna get their money back unless the company just completely goes under. All right, so with that, 7 o'clock next in your